Hello traders and welcome to another video. So in this video we are going to talk about change of character. So basically reversal trades. How should you take them, when you should take them, what is high probability when you're looking at change of character trades, what is less probability, etc, etc. So we are going to talk also about the difference basically really between change of character and break of structure. So what are the benefits, what are the advantages, disadvantages, etc, etc. So guys, first off, when you're trading continuation trades, when you're taking continuation trades, break of structure, so you're gonna have, as we mentioned in previous videos, impulse, correction, impulse, correction, impulse. So you're gonna have this impulsive break of structure, impulsive break of structure. And this way, guys, when you're trading continuation trades, your trades are going to be more high probability. Why? Because first, price is clearly indicating to you that momentum is, going up. Market is trending to the upside. There is impulsive break of structure. You have structure on your side. Order flow is on your side. There's a lot of different confluences when you take continuation trades in the trend, when price is indicating you momentum in one direction, and your trades are just gonna be more high probability because you are trading with the trend, with the direction of the trend. So you have less, you have less things to worry about, and your trades are going to be more higher probability. But when you trade change of character, guys, you somehow need to see and spot where is that trend going to end. So picking and trading reversal trades can be more tricky, but also at the same time they are going to give you better risk reward trades. Okay, why? Because let's say we had this trade, and let's say we had an inside bar candle, for example, here, and we had our demand zone here, and we took the trade. As we broke the high, we would manage our profits, etc, etc. As we break this high, we will lock our profits here, and let's see what happens right now. So let's say price makes this, price does this is standing price action. Okay, so you would be long gone out of the trade. If this happens, you will be out of the trade immediately, because right now you're spotting that price action is showing you weakness to the upside. And what is tricky about this is that you are going to have, let's say for example, you're going to have imbalance behind here, you're going to have this ascending price action indicating weakness to the upside. You're going to have this change of character, and you're going to want to trade this order block to take your shots from here for that trend reversal. Because remember, guys, this is how market moves. Market moves in this uptrend, for long periods of time, and then the reversal happens and markets change the direction. So basically this is how market moves: up, down, and sideways. And those kind of trades can get a little bit tricky, but they can bring you a lot of risk reward, really big risk reward trades. For example, if you take this trade and you were right, and this was your really indication that price doesn't have momentum to continue to downside, that we're most likely going to see downwards momentum. If you take your trade here and price just feels this imbalance here, maybe we have liquidity here, maybe unmitigated order blocks, trend line liquidity as well, your trades are going to be really massive. You're going to have massive risk reward. But the risk that you're taking is that price is still in an uptrend, so what can happen is that you're gonna get something like this, and price just gonna continue to move to the upside, and either you are going to finish on break even maybe, or you're gonna manage to reduce the risk, or you're gonna maybe earn some quick profit, or you're gonna take a full loss. You never know what's gonna happen. But again, at the same time, it's hard to predict when that reversal is going to take place. So you need to pick them carefully, especially when you're trading some pairs like JPYs. Okay, so JPY pairs, they love to do this. Okay, you're gonna have a longer standing price action, and then you're gonna see a breakout, and it's gonna be a fake out. Price is gonna trap breakout traders, breakout retest traders, smart money traders. Price is gonna continue to the upside. It's gonna do this again. It's gonna make change of character, and then it's gonna trap breakout traders, breakout retest traders here, or block traders here, and it's gonna continue to move to that upside. So this happens a lot. So this is why when you trade reversal trades, they can get a little bit trickier, so they are less high probability than when you take, continuation trades with momentum, with the market direction, with the current market structure, etc., etc. Okay, so they can be a little bit tricky. This is why I like to take reversal trades on AUD USD, but I like to take them like this. Price is gonna move in this descending price action, showing me this structure, and usually after every breakout and creation of new lower low, we start to see a pullback, and then this is where I want to get involved in that change of character. This is where I want to get involved in that new created supply for that creation of the new lower low. And this is how market moves. You're making the lower low, a standing price action, new lower low, a standing price action, new lower low, a standing price action, new lower low. So this is also how you can take reversal trades. If you have a reversal trade opportunity here, you can take it for a creation new lower low, and then you can take it here, you can take it here as well. So basically you can have also reversal trades in the overall continuation. Okay, so this is how you're gonna boost a little bit that confluence of having more high probability reversal trades than only just to spot that market reversal. To catch that market reversal, it's a little bit hard. It's a little bit hard. You never know when is that going to happen. Market can give you a lot of false information, to get you trapped, etc., etc. So, of course, I trade reversal trades. Everybody trades also reversal trades. You should just know that trading continuations overall is better, than taking reversal. But again, we are going to talk about, different things, what we want to see when we're trading that change of character, when we are taking that reversal trades, what needs to happen, what is more high probability, what is less high probability. So yeah, basically, when there's a reversal trade, you're going to see that price is making this ascending price action. So you do not want to get involved in reversal trades when there is a trend, when there is a really, really nice and impulsive trend. So for example, you're going to have impulse, correction, impulse, correction, impulse. You do not want to get the reversal here. Why? Because market is clearly indicating momentum. You want to get involved in reversal trade when there is a weakness in the market, when price action is making this ascending price action. So when price action is making, market is making this, ascending price action, you're gonna have, creation new higher high, and then you're gonna have a retrace, and then we're gonna barely break that high, not impulsively, barely, and then again immediately after we break the high, retrace. Again, we're breaking the high, retrace. This is indicating to you that there is no momentum in the market, and you are then going to wait for that change of character to happen, to take your trades and to go short. So first thing that you want to see is break of structure, standing price action, indicating weakness to the downside. Then you want to see that this low gets taken. Okay, so this is what you're looking for. So basically you're gonna have something like this, ascending price action, and you're gonna look at how do we break this low. If we break this low impulsively, this is one of the confluence that markets really want to reverse. So for example, you can see that here we are breaking this previous low pretty impulsively. There is a momentum in the market. We have left a balance behind. We have really strong candle close. We have no retraces in this momentum, so momentum is clean, okay? When the momentum is not going to be clean is if we break, for example, only with the wick. So let's say this candle doesn't exist. Let me move it. So this candle doesn't exist. And you're gonna have like a big wick like this. You're gonna have something like that. If market, if this low is taken only with the wick, this is indication that price action is rejecting this low and there is not enough momentum for us to get involved here. The same principle goes if there is a weak breakout. So if there is only a little bit of breakout, and let's say we do not have a big wick, but we only took this low barely, okay, with no momentum. And if then you see, you know, price coming back to your order block, again, this is considered less probability trade. Why? Because we do not have enough momentum involved here. And again, guys, when is the right moment and when is high probability to take reversal trades is when there is confluence involved. When there is a clear market breakdown of this low, so we're breaking it impulsively. So first thing, what are you looking at? How do we break the low? Okay, if we have impulsive break of the low, this is first confluence that you're looking at. Second confluence that you're looking at is that you want to have imbalance left behind. Okay, so you do not necessarily need to have it, but you know, it's just one of the confluences. Third confluence is that you want to have a clear momentum with no retraces in momentum. That's the third confluence. Fourth confluence is that you have a strong candle close. So if you, for example, break the low impulsively, you have no retraces, you have left imbalance, but the end of that impulse, so you have all of those three things, and then the last thing, you know, price leaves a wick behind. This is considered bad, okay? So right now I'm also going to explain how wicks work. So if we see at the end of this momentum that price has left a big wick, we can expect two things, okay? First thing is volatility. If price action comes down with this momentum to the downside, makes a wick, and with the same momentum comes back to our order block in form of that V, like volatility, this is our indication that the trade is aggressive to take. And the most likely thing that is going to happen is this, or bigger correction. So this is why when you see a big wick, an aggressive pullback coming back to your order block after that wick, this is considered aggressive. When you see a big wick, the second thing, when you see a big wick and you see that ascending price action coming back to our order block, so bigger correction, that means that this wick was respected. Okay, so two things when you're looking at the wick, big wicks. If we see a momentum coming back to our order block in form of volatility, we're not taking it. It's less probability. If we see a more corrective approach coming back to that order block, you know, breaking highs, retracing, breaking highs, there is no momentum, you know, strong momentum to the upside, this is considered that wick is respected and it's high probability to take this order block even if we have a big wick. Okay, so again, guys, let's say we didn't have a wick, so I wanted to show the example of what happens when you have a wick. So let's say we have a strong close. What now we want to see is that we want to see a market coming back correctly in this form of ascending price action. So building liquidity on the way up. So this is going to indicate to us that there is no momentum in the market. Price is breaking highs and retracing. You know, price doesn't want to continue to go to the upside. And our order block here is most likely going to work. And we can, with all those things, you know, all those confluences, we can combine them together and we can really say that, okay, this is high probability change of character or high probability reversal trade to take for me. You can have loads of different things right now that you can combine with those stuff. You're going to have maybe, you know, a standing price action. You're going to have a breakout, impulsive breakout, but you're going to have a wick, a big wick. Maybe it's going to be a bad confluence. And, you know, you're going to have respected wick, and maybe you're gonna have, you know, inducement here happening, and even though you have a big wick and maybe, you know, not that impulsive break of the low, you're gonna have other confluences like liquidity here, wick being respected, and then, you know, you can take your trades as a reversal trade because you have a lot of other confluences. You can combine all those confluences, but if you want to say the most high probability trade ever is weakness here, breakout here, impulsive break of this low, impulsive move here, no retraces, imbalance left behind, strong candle close, ascending price action, coming back to our block, building liquidity on the way up, and then you want to short. This is high probability reversal trades that you're gonna take. Okay, so guys, right now I'm gonna show you an example of, you know, high probability change of character on the chart, and when you should stay away and not trade reversal trades that much. So here I have example of an AJ, really nice trade, beautiful trade. Price was clearly showing us here, as you guys can see here, we had this impulse to the upside, leaving imbalance, and then price just made this ascending price action. Beautiful little ascending price action, guys. As you guys can see, we're breaking these highs, retracing. We are breaking these highs, retracing, breaking the highs, retracing, breaking the highs, retracing. So this is our indication that market price action doesn't want to continue to the upside. And then we're looking at how we're breaking this low. Okay, so we are breaking it impulsively. Okay, you have seen 1, 2, 3, 4 candles, 4 bearish candles push. We are breaking this low. After that, we have also imbalance behind. We do not have any retraces. The thing is here that we have a big wick. Okay, so right now you're combining pair characteristics, and you know this is AJ. For AJ, the wick doesn't play that big of a role, but again, still it's a wick. So if we see aggressive pullback to our zone on volatility, we do not consider taking it. But if we see a corrective, you know, price action playing out, then this wick is respected, and we can say this is higher probability trade. So as you guys can see, price made almost touched our block here. This would be entry on volatility, and it would be considered bad, but all of a sudden price, as you guys can see, didn't touch our entry. We didn't have an entry with this first move. Then we start to range, we build a liquidity here, we build a liquidity also here, as you guys can see here. So we have a liquidity for to the downside, we have liquidity to the upside to induce those people before we take the trades, and also we have a target, you know, this imbalance. We can target also this imbalance. So as you guys can see, perfect entry, both price melted down. Also to mention that this is also, we know that this is Euro JPY, so JPY pairs can give you a lot of fake outs, but when trend is ascending, so when there is a longer ascending trade. In this bit of price action, we can see that price action was going to the downside, and this was a little bit of fake out, so you can trade those as well. You're gonna have, you know, ascending price, descending price action like this, and price is gonna do this, and all of the traders who are trading breakouts are gonna buy here. There are break of retest traders, they're gonna trade here, and there are smart money traders who are gonna trade here. And what price action does sometimes is that it's gonna indicate to us weakness here in form of this ascending. It's gonna do this, and it's gonna give us an entry, and it's gonna take them all out, and we're gonna make a new lower low. So this is also how you can take trades, reversal trades, you know. So you're combining all the things together. So this is an example of, you know, how that high probability trade should look like. You know, again, imbalance left behind, you know, as extra confluence, weakness to the upside in form ascending, impulsive break of this previous low, wick left behind but wick was respected, liquidity building on the way up, retest of this previous order block, and then boom, price action melting down to the downside. So this is considered high probability when you're trading high probability reversals. And guys, right now I'm going to show you what I mean by JPY pairs and what I mean by you have a lot of fake outs. So you're going to see the prices moving in this ascending price action, not quite breaking the highs impulsively. It's more of a ascending trend, but this happens all the time on JPY pairs. So you're going to see the price action is moving in this ascending. Right now here you have a order block. Here you have a order block, and what price action did? you have this imbalance as well. You have a impulse imbalance. You have ascending price action. Look at this. You have ascending price action. Price then broke all of this, and then start to go to the upside. And then what happened? Boof, price took them out. So look at this. And you're gonna have this was aggressive coming back to the volatility, as you guys can see. As I mentioned, this is volatility, price action coming back to that lower block. So this is volatility, price action moving to the upside. And then here also as well, you have longer ascending, and then price breaking this low, and again you have a volatility, boom, aggressive pullback. This is destroyed. It's a lot of fake outs here as well. You have ascending price action, price breaking above, and then even ranging. You know, you had a weakness here, but it was respected, and then boom, you know, taking you out. And then again here, you didn't had a lot of momentum here. You have a lot of weaknesses, retraces in a momentum. But again, the same thing. You know, there are traders who are trading breakouts here. There are traders who are trading breakout retests here. There are traders who are trading supply here. All of them getting caught in this fake move, and price continuing to the upside, continuing to the upside, continuing to the upside. Here as well, one candle breakout. You have imbalance left behind. You have this ascending price action. You have one candle breakout. It is better always to look at more candles. So when you have a breakout, you're looking for 2, 3, 4 candles. You know, one candle is not that safe, but again, you can still trade it. But again, volatility as well here, guys. But all of those traders are getting caught on the wrong side of the market. Why? Because they do not look at the price action. They don't necessarily, you know, read the pair characteristics like we do. So just to let you know, when you're trading reversal trades, guys, they can be a little bit more risky. You know, you can earn really good percentages when you take them, and you know, when they play out, it's gonna be massive risk reward trades. But again, they can be tricky. So it is again more safer to trade continuations with the trend, with a lot of other confluences, than to try to predict when the, you know, trend in the market is going to end. And just to let you know that you need to watch out in these kind of situations when you have on JPY pairs, when the price action is moving in this ascending and then fake out, boom, it's gonna just happen. It's gonna happen a million times. It's just gonna happen a million times. You're gonna get change of character here, change of character here, change of character. It's gonna trap all of them. Breakout traders, breakout retests, supply traders, breakout traders, breakout retests, supply traders. All of them are gonna get caught in the wrong side of the market, but it's gonna keep ascending to the upside. So yeah, that's pretty much it in this video, guys. Hope you liked it, hope you enjoyed it, hope you learned something new, and yeah, see you in the next one.